Right now, as we watch the ticker tape scroll by, Beyond Meat, trading under the symbol BYND, is sitting at exactly $0.86 per share. We're looking at a brutal intraday movement, with the stock down roughly 16% so far in today's session alone. The volatility is palpable, and the volume is spiking as traders react to this latest leg down. To put this in perspective for anyone watching who might be new to this specific equity, seeing a former market darling trade below the $1 mark is a psychological breaking point. It is not just a red day, it is a capitulation event happening in real time. If you are watching the order book, the selling pressure is relentless, with bids getting hit immediately as they appear. This brings us directly to the core tension of this asset, the massive gap between what investors expected this company to be and the cold, hard reality of what it is today. The expectation was that Beyond Meat would be the Tesla stock of the food industry, a high-growth, tech-like disruptor that would fundamentally change how humans consume protein. The narrative was perfect: save the planet, improve health, and make a fortune doing it. Investors priced this stock as if it were a software company with infinite scalability. The reality, however, has been a harsh lesson in the economics of packaged goods. We are not looking at a high-margin tech monopoly, we are looking at a capital-intensive, low-margin food manufacturer fighting for shelf space in a highly competitive grocery aisle. The reality is that consumer demand has softened. Inflation has made premium alternatives less attractive, and the company is burning through cash at an alarming rate. If you held on to the belief that this was the next Apple stock or Nvidia stock in terms of trajectory, the market is currently telling you that the thesis is broken. Let's examine the recent price action because it tells a fascinating story of exhaustion. The stock has been sliding for weeks, but this recent drop to 86 cents represents a critical failure of support. We're seeing a complete unwinding of the post-earnings optimism that briefly lifted shares earlier in the month. When a stock breaks below $1, it triggers a different set of risks, including potential delisting notices from the exchange, which adds a layer of structural pressure to the selling. Institutional algorithms and retail traders using platforms like Robinhood or engaging in Robinhood stock trading are likely exiting positions to avoid the complications that come with penny stock territory. The volume today is significantly higher than the average, indicating that this is not just retail panic, funds are likely liquidating positions. When you see this kind of volume on a down day, it suggests that the smart capital is moving out, leaving retail investors to hold the bag. The broader market context is also working against Beyond Meat right now. While the general indices might be holding up or showing mixed results, high-risk, unprofitable growth names are being punished. Investors are seeking safety and yield, moving away from speculative plays. If you are managing your own funds, perhaps through self-investing or using tools like Schwab Intelligent Portfolios, you might notice that the algorithms are automatically underweighting or completely removing exposure to companies with balance sheets as precarious as Beyond Meat's. This automated selling pressure creates a feedback loop. As the price drops, the risk metrics worsen, prompting more selling from automated risk management systems. It's a vicious cycle that is difficult to arrest without a major fundamental catalyst. We need to talk about the specific mechanics of this decline. It's not just about sentiment, it's about liquidity. The bid-ask spread is widening, which is a classic sign of low liquidity and high fear. Market makers are not willing to take on inventory in a falling knife scenario, so they lower their bids, forcing sellers to chase the price down. If you are using a Fidelity trading platform or looking at your Fidelity brokerage account, you might see this reflected in the execution prices. Slippage is real in this environment. The intraday chart shows a series of lower highs and lower lows, a classic bearish trend that has not found a floor yet. There's no consolidation pattern forming, it's just a straight line down, which suggests that the bottom is not in. This leads us to the fundamental analysis of the company itself. Beyond Meat is essentially a food science company. They manufacture plant-based meat substitutes that aim to replicate the taste and texture of animal meat. Their product line includes burgers, sausages, ground beef, and chicken alternatives. In the early days, this was a novelty. People were curious, but the food business is driven by repeat purchases, and that's where the company has hit a wall. The novelty has worn off, and the core consumer base has not grown fast enough to support the massive valuation the company once held. They are dealing with what we call a churn problem. People try it once, maybe twice, but they don't necessarily convert into weekly buyers. Furthermore, the ingredients list and nutritional profile have come under scrutiny, challenging the healthier narrative that was a key selling point. Financially, the situation is precarious. The company is carrying a significant debt load, and with interest rates where they are, servicing that debt is becoming increasingly expensive. The cash burn rate is the metric that keeps analysts awake at night. They are spending more to produce and market their products than they are bringing in from sales. In a zero-interest rate environment, you can get away with that. In today's economic climate, cash flow is king. You can't pay bondholders with revenue growth promises. You need actual cash. This is why we see such a disconnect between the stock's performance and the broader market. While companies like SoFi and their SoFi Invest platforms are seeing inflows into diverse assets, capital is actively fleeing the plant-based meat sector. The competitive landscape has also shifted dramatically. When Beyond Meat first launched, they were the only game in town, or at least the loudest. Now, every major food conglomerate has their own plant-based line. These competitors have deep pockets, established distribution networks, and the ability to undercut Beyond Meat on price. It's the classic David versus Goliath story, but in this version, Goliath has a better supply chain and higher margins. If you are looking for investment help or browsing investing sites, you will often see analysts highlighting moats, competitive advantages that protect a business. Beyond Meat's moat has proven to be quite shallow. The barrier to entry for making a veggie burger is not as high as making an electric vehicle or a high-end GPU. This lack of defensibility is hurting them. Let's pause for a second and bring this back to your portfolio. Comment below how many shares of Beyond Meat you currently hold and what your average cost basis is. Are you looking to average down at these levels, or are you looking for an exit strategy? It's always interesting to see where the community stands on these polarizing stocks. Continuing with the analysis, we have to consider the macroeconomic factors pressing down on this stock. Inflation is a double-edged sword for Beyond Meat. On one hand, meat prices have gone up, which should theoretically make alternatives more competitive. On the other hand, inflation has squeezed the consumer's wallet. When people are tightening their belts, they tend to stick to staples and cheaper proteins. Beyond Meat products are typically priced at a premium compared to conventional meat. In a recessionary or inflationary environment, that premium becomes a hard sell. It's a luxury item in the grocery cart, and luxury items are the first to go when budgets get tight. This is a trend we're seeing across the board, not just with BYND, but it hits them harder because they don't have the pricing power to pass costs on to consumers without killing demand. Institutional activity is another layer we must analyze. We know that heavy hitters like BlackRock and Vanguard have involvement here, but we're also seeing high short interest. Short sellers are betting that the price will go lower, and they have been right for a long time. When you have a stock with high short interest, you always have the potential for a short squeeze, a rapid increase in price as short sellers cover their positions. However, relying on a squeeze is a gambling strategy, not an investment strategy. If you are trading on Robinhood Crypto or using